segment, Quarter Se Quarter Tak. We bring you earnings expectations from various sectors as we hit the earnings season. First off the block, of course, will be IT services. So, Reema, over to you.
Thank you very much for that. I think the big question that we're asking at the beginning and at the end of the Q1 earnings season is, are we at the end of the earnings downgrade cycle? Now, Indian IT companies have seen significant negative revision in their earnings estimates over the last 2 quarters. This table by UBS, which will come up, is very telling. Estimates were brought down in Q3 also, but in Q4 in particular, estimates were lowered by as much as 15% for Infosys and for Wipro. So, some people on the street believe that EPS estimates have been downgraded enough, and therefore there is little room for further downgrades. Now moving on to what we're expecting from this quarter, an improvement in the quarterly growth rates. Now this will be led by 1, seasonal strength. Q1, Q2 are typically stronger quarters. 2, ramp up of the large deals which the companies had won in the prior year. And 3, reducing intensity of cuts in discretionary program. Now here is the CNBC-TV18 poll. Infy is likely to see the highest growth at 2.35%, followed by TCS at 1.5%. Wipro is likely to see flat growth, but for HCL Tech, we could see a decline of about 2% on a quarter-on-quarter basis in terms of their revenues. Now, the reason why Infy is likely to lead in terms of a growth rate at about 2.4, 2.5% is because of the ramp-up of previously won deals and a low base. For TCS, it will be the ramp-up of that BSNL contract, which still continues to contribute. Now, Wipro is where the street has turned incrementally most bullish in the last 2 quarters. Remember, there is a new CEO on board. There's hope of a buyback too. Now, for Wipro, after 5 quarters of a revenue decline, this time, the street is hopeful that at least the decline in revenues has been arrested. In Q1, we could see a flat growth. And remember, I told you for HCL Tech, revenues are likely to fall by approximately 2%. Well, the company had guided last quarter that offshoring of a large project is going to hurt them. Now moving on to the full year annual guidance. Expect the companies to hold on to their guidance. So for Infy, it stands at 1 to 3%, margins to be maintained at 22%. HCL Tech too likely to retain its revenue and margin guidance. CLSA says a stable guidance is a positive. Now, Wipro gives you a quarterly guidance. So for next quarter, many believe that it should be 0 to 2%, though some believe they could still give a guidance of minus 0.5 to 1.5%. Now, brokerages have been mixed. Very recently, Nomura, if you remember, turned positive on the sector. There was a double upgrade by CLSA on Wipro, which lifted the stock. That said, there are still many notes of caution. CLSA is cautiously optimistic on the sector. They say we still remain largely in an earnings downgrade cycle, but we are getting into a more stable or positive narrative. Jeffrey, UBS selective on the sector on the back of rich valuations. Now moving on to the risks. 1, the run-up in the stocks. Stocks have seen a run-up of close to about 15% in the last 1 month itself. 2, there is no immediate demand recovery. Sectors like BFSI, retail, telecom continue to remain stressed. Growth expectations have been pushed forward. And finally, valuations. Valuations are at a premium. CLSA says the Nifty IT is trading at a 30% premium versus an average of 20% to the Nifty, implying limited room for multiples to re-rate sharply from here on.
Okay, all right, Reema, thank you very much for that. Let's take this forward with Abhishek Bhandari, who is Executive Director, Technology and Internet Equity Research at Nomura, India. Abhishek, good to have you with us here. Good morning. Thanks for your time. Prashant this side. For viewers who are watching, Abhishek, going into this earnings season, which are the stocks which will make them money? I mean, simple question. Or do you think, as Reema pointed out, with the 10-15% run-up that we've seen over the last fortnight, last 1 month, this earnings season reaction is largely in the price already? What's your sense?
Hi, Prashant. Good morning. Good to be on your show. So on the first point, I think we are at the bottom of earnings downgrade cycle. And, we might be looking at an improvement in discretionary demand sometime in early next year, once the rate cut cycle starts and the US election gets over, fueling optimism with the US corporates. Do note, we have a G2000 proprietary database, which indicates incremental stress on the revenue growth for enterprises is slowing down, which means the bad news on discretionary is going to be low. So in that backdrop, I think the investors should, start looking at this sector more constructively. I think specifically on your question, going into the results, we think among the large caps, Infosys and Wipro are the ones where we are most bullish on. Because we think in Infosys case, the first half is going to be very strong given by their ramp up of deals. And next year, once the discretionary picks up, we think it will benefit disproportionately. On Wipro, again, I think, as Reema pointed out in the prepared comment what you guys shared, we are staring at a end of revenue decline from a quarter-on-quarter perspective. And do note, we are quite optimistic on the new CEO, who we think is the insider experiment with in the company after two so-called semi-successful experiments with the external CEOs in the last two stints. And we think the early signs in terms of deals and in terms of them growing, getting their revenue decline arrested is there. So among the large caps, Infosys and Wipro. In the mid caps, we like Coforge and Birlasoft, and we recently also upgraded First Source, which is a BPO company.
All right. Hi, Abhishek. Good morning and good to see you, Win. The argument is that, in fact, if we are at end of the earnings season, that's great news. But some of these stocks have run up considerably just in the last 45 days or so. And if you look at the Nifty IT index, well, it's trading at a premium in comparison to what it trades at, say, in a 5-year average, or even in comparison to the Nifty. Do you think it's warranted? And is the possibility that we see actually margin surprises from here on, which in that case will not make the premium look that much?
Yeah. So, on the first point, I think, the sector is at an inflection point in our view. And we have seen in the past, whenever that inflection point comes, first the multiples increase and then the earnings upgrade cycle follow. Do remember, we might also have the narrative on Gen AI start building up in next 18 to 24 months once there's some stability in macroeconomic cycle. And any new technology is generally considered to be positive from an Indian IT point of view. So the premium expansion can be justified if one looks at a medium term growth on revenue. From the near term, I think the stocks have gone up quite well. That's on back of possibly an expected stable quarter. If there is no disappointment on earnings, I don't think there's any reason why the stock should fall. There could be some stray incidents where the run up on the stocks is probably slightly more. If you look at likes of Persistent, which is trading at a very healthy premium compared to the broader IT index and also its peer set, the expectations of a strong growth continuing into future is very high. So I think there will be select stocks where one needs to be a little careful. But broadly speaking, we are not that negative on the run up into the result.
Okay. Abhishek, thank you for joining us. I think you said Infosys and Wipro is what you're most bullish on, right? I wanted your thoughts also on TCS, because it is a big beneficiary of this rise that we're seeing in digital transformation deals. I mean, even in the quarter gone by, if you hark back to what they did in Q4, right? It was the highest ever deal signings that TCS did. Do you expect them to build on to their gains here? And I mean, you recently upgraded it as well. So take us through your rationale there.
Sure. So, on TCS, I think this year, which is FY25, their growth rate will be definitely, higher than the peer set, partly aided by the BSNL project, which alone will contribute almost 2 percentage points for the full year growth. Having said that, if our thesis is on a potential improvement in discretionary, maybe, few quarters down the lane, I think there are other stocks which will benefit more given their portfolio compared to TCS. TCS actually has the, the stability of a very big portfolio on cost optimization. It plays to its strength over there. On the deal side, I think, we are looking at a deal run rate anywhere between $8 to $10 billion, barring any mega deal what might come into the way. This $8 to $10 billion has been the run rate for past few quarters. But do remember, despite such large deals, the translation into revenue is slow because of the longer duration of these projects. So I think, on the upgrade part, I think while we have upgraded the stock to a neutral, I think, we are still preferring Infosys and Wipro among the larger ones over TCS.
Abhishek, this basic thesis that we will see a turn in demand maybe early next year, wouldn't that depend on the underlying economy in the US, if that is the big market which matters? And we've been waiting for a slowdown there for a while, and finally cracks are emerging. It's been an incredibly, exceptionally strong US economy. Expectations are that it'll be very nice. It'll be a nice slowdown, not a out of control one, but who knows? So I'm just saying, is that a big if in that sense?
See, the biggest risk to our thesis is, any black swan event. If there's any credit crisis or any similar event in US, I think then, all the estimates fall off the cliff. Having said that, again, taking you back to the core of our thesis is the proprietary G2000 database what we maintain, which tracks the revenue growth rate of largest 2000 companies in the world. And to us, that's the lead indicator of technology demand, because the revenue spend, the tech spending is a function of revenue spending. And do note, this was the backdrop of us downgrading the sector in May 2022, when we saw early signs of decline in those revenues. Now, what we're seeing is, from a near term, a stability in that revenue from a calendar 24 perspective, and in calendar 25, we are seeing an improvement from almost -1% in 2024 to around +3.5% in 2025. So I think if things remain as they are, which is a gradual slowdown in terms of gradual fall in the interest rate, US election ending, and the optimism building thereafter, I don't think there's too much of risk. Black swan is anybody's guess. We don't take a call on that.
All right. We leave it there. Abhishek, thank you very much for your time. Appreciate it very much here on CNBC TV18. We'll speak again once we have the earnings in hand. We'll take a quick commercial break here. We'll come back. The market's down about, 18 points or so at 24,300. We're back and we'll put the focus on commodities. Manisha is going to be here to do that. Stay tuned.